Hey. Today we're going to be talking about Roth IRAs, which is a very boring retirement account. And I get it. It is so boring. I don't even want to talk about it today. I don't even know why I'm making a video about it today, but I think it's very important to learn about Roth IRAs for many reasons. Number one, it's very important to be financially stable for your future. So a Roth IRA is an account that you can contribute to every single year up to $6,000. And if you're over 50, you can contribute up to $7,000. But here's the caveat. You have to have the account for over 5 years, and you have to take it out by the time you're 59 and a half. If you do not do those two things, you will get either penalized or taxed or both. So here's the thing. Why do you want to put $6,000 a year into this account? Well, once you do that, you don't have to pay taxes on your withdrawals. So let me go more into this. What exactly do I mean by you don't have to pay any taxes on your withdrawals? Well, when you put money into a Roth IRA, what are you putting in? Pre-tax money or after-tax money? Well, for a 401k, you're putting in pre-tax money. So that means you get a tax deduction for that year because essentially you're lowering your income to contribute to this 401k. However, for a Roth IRA, you're contributing after-tax income. So that means you're getting taxed and you're putting that money into this account. So the money that's in a Roth IRA can grow no matter what. It can grow from 10,000 up to $1 million, whatever it is, and you're not taxed on whatever happens. So let's say you're 25 years old and you put in, by the time you're 40, let's say you put in 100 grand, and that turns into $1 million by the time you're 65. You're not taxed at all because you were already taxed when you first put the money into a Roth IRA. So that is one good thing. If you're in a lower tax bracket, then a Roth IRA is a great thing to put your money into because let's say you think in the future you'll be in a higher tax bracket that you won't get taxed. You're getting taxed at a lower tax bracket. So if you're 20 or 25 and your tax bracket is 20%, then I would definitely contribute to a Roth IRA because if you think your income will be over that, let's say your tax bracket will be 35% by the time you're 60, you do not want to pay taxes by that time. Pay taxes today at a lower tax rate, then let your money grow tax-free essentially. Then when you can take it out, it's all yours. Instead of with a 401k, when you see your balance, you have to take out the money, but then you have to pay taxes on that on top. So it kind of sucks having a 401k at that point because when you're older and you see your balance being, let's say, $1 million, it's really not $1 million. You have to pay taxes on the cap gains. So just so you guys know. Who exactly can contribute to a Roth IRA? Well, you have to either make under $139,000 a year if you're single, and if you're married, it has to be under $206,000. What exactly does that mean? Well, if you make $139,000 or more, you cannot contribute to a Roth IRA. They want people that don't have that much money contributing to a Roth IRA because they don't want wealthy people taking advantage of the system. This is really meant for people that don't make that much income and they want to help you guys out. They want to help people that really need the help and they really help people below those thresholds. So $139,000 or below if you're single and $206,000 or below if you're married. And just like I stated before, your contribution limit is $6,000 a year until you're 50. If when you're over 50, you can put in $7,000. Now, why is this important? Well, it's called catch-up contributions. So if you're over 50 years old, the government sees that, hey, listen, this person's getting older, reaching retirement age. Let's help them help themselves reach that goal that they want to get for retirement. So they let you put in another $1,000 a year toward your Roth IRA. Really important to know. Another important thing is to know required minimum distributions. So for a 401k, you have to take a required 401k minimum distribution at the age of 72, actually. With a Roth IRA, there's no such thing. You don't have to do a required minimum distribution, which is great because that means your money can compound. Let's say you retire at 70 and you don't want to use that money until you're 90. Essentially, you don't have to take out any distributions until you're 90 or until you die. Your relatives can get it as inheritance and they can cash in or let that compound even more for their grandkids or whatever. With a 401k, the money cannot compound after you're 72. You have to take out the money by the time you're 72, but with a Roth, you're golden, you're good. You can let that money grow as much as you want until you die or to give it to other family members. Now, is a Roth actually insured? Yes, it is. It is insured by the FDIC up to $250,000. So if you're fortunate enough to have a Roth IRA account with $250,000 in it, you're fine. If anything happens, you're insured up to $250,000. But now let's get into something more interesting, because insurance is really important, but as everyone knows, it is the most boring topic ever. Contributions. What can you contribute to a Roth IRA? And what exactly do I mean by that? Well, let's say you have passive income. Let's say you have rental income, interest income, pension, annuity income, stock dividends, and capital gains income. That is all considered passive and not earned. So you cannot contribute that income towards a Roth IRA. However, if you have earned income, such as a salary, commission, bonuses, or if you have divorce-related income, such as alimony, child support, or you have a settlement, that could be contributed into a Roth IRA. So it comes down to this. If you make earned income and you're under the threshold of $139,000 single or $206,000 married, you can contribute to a Roth IRA. However, if you have passive income and you're making over that threshold, then you cannot contribute to a Roth IRA. So it's very important to know that yes, it is FDIC insured. You can contribute up to $6,000 per year if you're under 50. If you're over 50, it's $7,000. You have to have earned income to contribute to a Roth IRA. That is very important to know. And also, here's another very special thing about a Roth IRA. You can have a spousal Roth IRA. So let's say your spouse does not work. Let's say he or she got hurt or they just don't want to work. Then if you have earned income, you can make a spousal Roth IRA for your spouse. However, you do not have control of that account. That account goes to your spouse, essentially, because it's under their name. So you're essentially paying your spouse their Roth IRA. You're giving them the money for their Roth IRA. And it's called a spousal Roth IRA. And you can put $6,000 if they're under 50. And if they're over 50, it's $7,000 per year. And it's very important to know this because I think if you want to put $12,000 a year into this, then that's the way to do it. If you want to have a spousal Roth IRA, give it to your spouse, another $6,000 every single year. So it's very important to know that this money is very limited because you can only contribute up to $6,000 per year if you're under 50. I think that's kind of like very limiting because with a 401k, you can contribute up to $19,500, and that is a big difference. However, don't forget, it is pre-tax income for a 401k, and when you want to take out the money when you're older, then you have to get taxed on that. So with a Roth IRA, you're getting taxed today, and hopefully your tax rate is higher when you're older, and you can actually save money on that because you already were taxed when you first put that money into a Roth IRA. So that's it. I just really want to tell you guys about this because I think it's a very interesting instrument that you guys can use, especially if you're at a young age and you're at a low tax bracket right now. Just do not forget that if you take out the money when you're 59 and a half, and if you have it for over 5 years, that is so important, the 5-year mark. You have to have this account for 5 years. If you have it over for 5 years and you're 59 and a half or older, then you're good. You take out that money, you have no penalty, you have no taxation, and you're fine. However, if you do not meet the requirements of the 5-year rule, you will pay a penalty of roughly 10% or even taxes if you're under 59 and a half. So please remember this because it's really important. So that's really it. This is a Roth IRA. I think you guys should really look into it if you want to have some good retirement income. Let's say you just want to have a good nest egg when you get older. Let's say you want to get that Ferrari, you want to get that nice apartment or a house, whatever you want. Kind of good to have some money laying on the side that you know that you can always touch. So that's it. That's the video for today. Hope you guys enjoyed it. Please like and subscribe to the Finance Radio if you can. I really appreciate it. And I'll see you guys next time with some more finance videos. Thanks.